Hello and welcome to this video on the costing method FIFO. A prerequisite for understanding this video is that you have a basic understanding of accounting, and if you don't, I suggest you watch my video Debit and Credit Exercises in Dynamics NAV. At the end of this video, you will have a general understanding of costing methods in general, and you will have an in-depth understanding of the costing method FIFO, and you will understand FIFO in Dynamics NAV and how it works. So what we're going to go through in this video is, first I'm going to introduce you to FIFO, and it's simply going to be a general talk on the costing method FIFO. And then we're going to switch our attention to NAV, and we're going to open Dynamics NAV and do some trading with an item which is set up for FIFO. So we'll be doing some purchases and a little bit of selling, and in this process I'm going to go through the concepts of cost of goods sold, the inventory value of this particular FIFO item, the item ledger entries, the value entries, the GL entries, and any relevant fields on the item card. And I'm going to investigate those different concepts for each transaction and to see how they change and explain to you why they change. Okay, so let's get into the basics of this FIFO thing. So imagine now that you have a company, and this company buys and sells coffee makers. So this company on a given date, in this case it's the 1st of June 2014, this company buys one of these coffee makers, and it pays $10 for this coffee maker. Then on another date, it buys another coffee maker. So now it has two coffee makers on inventory. But on this date, which is about 2 weeks later, it pays $18. So we have a difference in the price between the first purchase and the second purchase. Then again, on the 30th of June, it buys another coffee maker, so that it now has 3 coffee makers on inventory. And this coffee maker it buys for $13. So why is it buying these coffee makers for different amounts? Well, that might simply be because the company that they are purchasing them from says that they have to buy it for at different prices. There's no particular explanation why the price would vary like this, but for some reason it's just more expensive on the 15th of June than it is on the other dates. So the outcome of these 3 purchases is that the company has 3 coffee makers on inventory, and the first one cost 10, the second is 18, and the third one was for $13. So the average is about, I think that the total of these, actually I've made this here over here, the inventory value before we make a sale, because we've only bought here, the value of these 3 purchases, so it's a total of $41. So the average cost of these coffee makers is about 13, 15, something like that ish. So the next thing that happens is that the company gets an order from a customer, and on the 1st of July, which is I think 1 day later, on the 1st of July, the company sells one of these coffee makers for $30. So the $1 million question here is, how much did we earn? So if we have bought these 3 coffee makers for different prices, and we have sold one of them for $30, well, the first question is, which one did we sell? Because the guy who goes out into the inventory, he just picks any one of these. He just picks a random one. So we don't really know which one physically has left our building. So how much did we earn? We know that the customer paid $30, but you could argue that if this coffee maker was the one that left the inventory, then we have had a profit of 30 minus 10. But you could also say, well, I guess it's this one which left the inventory, or maybe it's this one. So if it's this one, it's $30 minus 13, so $17 we have had in profit. If it's this one, it's $20 in profit. You could also argue that the profit we have made is the average of these 3 coffee makers. So, and the average was about, did I say about $13, something like that. So you could make different kinds of assumptions about our profitability. So to answer the question, how much did we earn, you have to force yourself to say, well, that depends on the costing method. In this case, we're using the costing method FIFO, and FIFO means first in, first out. So the assumption is always that it's the oldest purchase which leaves first. So the one of these 3 coffee makers that came into the inventory first, so first in, is also the one that leaves the inventory first, so first out. First in, first out. So to answer the question, how much did we earn? Well, we are now using the costing method of FIFO. So that means we are going to assume that it was this coffee maker which was removed from the inventory, and as the cost of this one is 10, we can conclude that from this particular sale we have made $20. So to conclude, the inventory value after the sale is now $31. Because now this one is no longer in inventory, it has been sold, which means that we have 2 coffee makers left, one at a price or at a value of 18 and another at a value of 13. So our inventory value after the sale is $31, and our cost of goods sold is 10, and cost of goods sold is this coffee maker here. Okay, so this is another way to look at those 4 transactions. First we have our 3 purchase transactions here, and the first one had a cost of 10. So if this is new to you, you should watch my video debit and credit exercises, and you will understand why I have these 5 entries into the GL when we buy something. Assuming that you have watched those and understand these entries, we have the first purchase here, which increases our inventory by 10. And then we have our second purchase, which increases our inventory by 18. And of course we have for all of these, for these 3 transactions, we have some VAT, we have some accounts payable down here for our creditors, and then we have these in and out of the cost section in our profit and loss. So the total or the final implication of buying these 3 coffee makers is that our balance on our inventory is 41, and then we have some VAT, some accounts payable, and no implications to the cost section in our profit and loss area. When we then sell this particular item, $10 leave our inventory, so that pulls down or reduces our inventory value to 31, which is the same as we can see over here. 31 here. And what we can also see is that our cost of goods sold is now 10. So those 10 that leaves our inventory have now been booked down to our profit and loss area here. And we have had a sale of 30. Keep in mind that when it says minus here, it's credit, and credit is the normal way to book into your sales section. So this illustrates that we have had a profit of 20. Alright, so now we are looking at NAV, and what we're going to do here is that I'm going to be setting up a FIFO item first, and then I'm going to put in a few transactions into the system. First I'm going to be doing 3 purchases on different dates or days, and then I'm going to be making a sale, and then I will explain those 4 transactions. Then I'll make another 2 transactions and explain those. And for these 2 explanations, I'm going to be looking at the inventory field, the unit cost field, the last direct unit cost, and the item ledger entry. I will look at the applied entries and the GL entries. So, first thing we need to do is to set up a new item. And let's call this a mag, as in magazine. So, magazines are sold in pieces, and we need to make sure that the costing method is FIFO. And in order to make these transactions, we need to set up these 3 posting groups. So general product posting group will be books, the VAT product posting group will be normal, and the inventory posting group will be books again. I have another video which is called starting a company from scratch, or setting up a new company, where I explain how to create these posting groups and also how to create the chart of accounts that we are going to be using in this demonstration or this video. So if you want to get into more depth about the posting groups, please watch some of my other videos. Okay, so now we've set up this FIFO item and we click OK. And the next thing is to do these transactions. I'm going to go through these rather quickly because it's not creating purchase invoices is not quite the topic of this video. So just going to give this a random number and buy from vendor. And then we're going to be making the first transaction on the 1st of January. So we go down here, and we probably need an vendor invoice number, otherwise we're going to get an error message when we try to post. But the 1st of January 2015, and we can also see that we need to buy one of the items, and we should be paying our vendor $10. So we go down here and select item, and we were buying a Mac. And we are buying one piece, and we are going to be paying our vendor $10 for this one. So let's get that posted. Alright, another purchase invoice, some random number, a vendor, 2nd of January, like this, some random information so we don't get an error message, an item, and choose our Mac, and we want to buy one piece of those, but we want to buy it for, this time, $18, like this. So we'll be posting this one. Alright, and we'll make the last purchase invoice here. And we'll be doing this on the 3rd of January, and some numbers here, an item, and it was our Mac. We want to buy one, but we want to buy it for $13. Alright, and let's get that posted. Yes, thank you. And then we're going to buy or sell one of these items. So we want to go to sales invoice. You can also go to sales order, but to keep things as simple as possible, it's better to use the sales invoice. So click Sales Invoice and New, and we'll give this a random number as well and sell it to one of our customers, a domestic customer, and we want to sell this on the 4th of January. So go back here to January, like that, and item will be our Mac, and we're going to sell this. We're going to sell one, and we're going to sell it for $30, as it says here. So let's get this one posted. Yes. Okay. And now we can have a look at the transactions and all the other things down here. So let's go to our item card. The item card of our Mac here. And let's have a look at the different things. Well, first let's just notice that we have 2 on inventory, which makes sense because we bought 3 and we sold 1. So that should be self-explanatory. The next thing we can look at here is the unit cost field, which is this one. What it says is that those items that we have on inventory, they have an average cost of 15.5. And we can look into the details of how it has come about, those 15.5, by clicking on this button here. And then we open the average cost calculation window. The first line here says that at the close of this day, our average inventory value was 10, which makes sense because we had just bought 1 and we had paid $10 for that one. The next line says that at the end of the 2nd of January, the average cost of the items that we have on inventory was 14. And we can see that we had 2 on inventory. And this actually makes sense because if we put 10 and 18 together, that makes 28, and half of 28 is 14. We can even look into the details of how it got to 14, because if we expand this one, we'll see that on this day our inventory increased by 18, and this is the data that we can put in. We can use to figure out how it came about an average valuation of our inventory items of 14. So the next closing entry here says that those 3 items that we've got on inventory, they have an average value of 13.67. And if we put all of these numbers together, we have 10 plus 18, that's 28. And we have another 13, and that is 41. And 41 divided by 3 is, I bet you, 13.67. And once again, we can see the contribution to why it has come about this by expanding here, and we will be able to identify 13 refers to these 13. So this is the first logic of this window. Then the last one says that at the end of this day, the ones that we had on inventory, which is 2, have an average value of 15.5. So how did it come about that? Well, the reason it's 15.5 is actually because it has reduced our inventory with 10. And this is exactly what FIFO is all about, because when we sold our 1 unit, because of first in, first out, NAV decided that it was the first entry, the one on the 1st of January, that was leaving our inventory. So this is why this has left. In other words, those 15.5 is the way that it has calculated that is by putting 18 together with 13, and those two combined is 31, or added is 31. And if because we have 2 on inventory, we have to divide that by 2, and 31 divided by 2 is 15.5. All this information or these calculations can also be seen out here in the cost amount actual column. So let's move on to the next topic, the last direct unit cost. The last direct unit cost is a little bit trivial. It's not so interesting in terms of FIFO. All it says is that last time we bought something, we paid $13 for it, and next time we raise a purchase order or purchase invoice, it will suggest us that maybe we will be paying $13 again. But this one will change every time we post a new purchase invoice. So item ledger entries. Let's look at the item ledger entries. If you scroll up here and click the inventory button here, you get to the item ledger entries. You can also reach those by going up here and say ledger entries. Personally, I've always been used to clicking here, so that's what I'll do. We have 4 inventory or item ledger entries, and this is expected because we had 4 transactions. In fact, we have 3 purchase ledger entries and 1 sale. And what we can see here, we can see the quantity as it increases our inventory from the first purchase, it increases our inventory from the second and also from the third. And then it reduces our inventory when we made a sale. We can also see here, or the question is that if we, or the question will be, which of these 3 lines or these 3 positive increases in inventory, which one did this sale take? Well, we know, or we would expect it to take the first in, first out. So this sale, we would expect it to take the quantity from this first line up here. And in fact, if we click on applied entries, hopefully that's exactly what we will see. So highlight this sales line and click applied entries, and we'll see 1 line, and you'll see that it refers to the entry number 12. And that's actually exactly the same line as this one up here. You see it says 12 here. So what it says is that when we sold this item, it took the item from this line up here. You can also see it the other way around if you want to see how this item left the inventory, or how this purchase left the inventory. You can say applied entries, and you will see the sales transaction, 15 and 15. It's very easy to understand the applications when you just have a few lines here. But imagine you have hundreds of lines, and you have to navigate all the way down here. Then it's good that you are able to highlight a line and then see how this is applied, or how it is paired up with the other entries, with the other item ledger entries. So that does it for the item ledger entry. Let me just say one more thing, which is you can see that our sales amount here was 30 and our cost of goods sold is 10. And that is because when we bought this first item, we paid 10 for it. So the last thing we want to look at is the GL entries. The GL entries of these 3 are slightly trivial, but yeah, let's just have a very quick look at them. You have 5 entries, and if we click on those, we'll have the 3 purchase entries. If you're not really comfortable with these things, I would suggest that you look at some of my other videos. which explains how these postings, or how NAV handles these postings. But we have the three purchase transactions, and then we have the two entries here which are responsible for pulling this out of the cost section and putting it into the inventory. So let's look at the GL entries for the sale. This is a little bit more interesting. Remember that we expect it to book $30 plus a little bit of VAT, and then we expect the cost of goods sold to be 10. So if we navigate this, you'll see that we have 7. First of all, we have 7 inches. And let's just start with the sale side. So these 3. We have, of course, some sale, 30. And then we have to also charge for some VAT. But then we have 4 cost of goods sold entries. What you can remember that we were expecting a $10 to be our cost of goods sold. And interestingly enough, if you look at this line along with this line, you will actually see that when we subtract those two, or these 3.67 from 13.67, it comes to 10. So the total is actually 10, exactly as we expected, and the reduction in inventory is exactly the opposite, which is also 10. But why did it split it up into 2 bits? Well, when you sell an item, NAV looks at the average cost of that particular item. So if you just go back to the item card and go into the unit cost and the average here, we'll see that when we sold this item, we call that this last line here represents the sale. So when we sold this item on this sales line, our average valuation of the items on inventory were 13.67. So this is how NAV does it. It registers this in 2 bits, and but because it would be wrong to register the cost of goods sold for 13.67, because we've just agreed that it needs to be posted for 10. So what it does is that let's just go back here. So what it does is that it splits those those postings into 2 separate chunks, and posts them like this. Alright, so the next round of transactions are these 2. So the first thing we need to do is to buy some more. So purchase invoice and new and some random number and a vendor. And on the posting date of the 5th of January, like this. And then we want to buy an item as usual, and it is our Mac, but we want to buy 10. And we want to buy them for a price of 15, not 13, like this. So 5th of January, 10 units, or 10 quantity 10, at a cost of 15. So let's get this one posted. And we need a vendor invoice number, anything random. And then we need to sell on the 6th of January 5. So we'll do a sales invoice here. Something random, our customer, on the 6th of January like that, an item, and our Mac, and 5 of those, and we will be selling them again for $30. So sale on the 6th of January, 5 of those for a piece value of 30. And we post this. And now let's go back to the item card of the magazine. Then the next thing, let's look at the unit cost field down here. It's now set to 15. So if we look at it, we will see that our closing entry down here is 15, or it is valued at 15. And the reason for this is, maybe it's easier to, if we look out here, we sold, or we bought 3 for different cost, whatever the cost was, and then we sold one of those. But then because and then we actually purchased another 10, but then we sold 5. So when we sold these 5, we had only ever sold 1 before, and this sale here was applied or attached or taken from this line, because when you sell something here, it takes because of FIFO, it would take the oldest remaining item in the inventory. So that means that when we sell next time these 5 here, that means that it will start eating from the back, and the first one it will take will be this one here, and the next one it will take, because there's only 1 in quantity, will be this one, and then it's going to be eating, because it needs to consume 5, but it only took 1 from this and 1 from this, so 2 in total, which means there are 3 left. So it will consume from this one. This means that the ones that are left are 7 quantities on this one. And as we bought these for 15, it makes a lot of sense that the average cost of the ones we have on inventory right now is 15. We can also see these 15.20. Those are the average cost of the items that were sold when we sold this, because this line is a sales line. So let's try to go back here. Average cost. So we've had a look at that one, and the last direct unit cost is once again simply what we purchased for the last time we made a purchase, what the cost was for that one. So let's go into the item ledger entries, and I'll explain it one more time from this perspective. We have 1, 2, 3, 4, 5, 6 lines here, and these 3 first here, we bought 1, and we bought another one, and we bought another one. We can see that none of these are left anymore. We can also see that, and we recall that this sale here was consumed from this one. So we can also see that of this purchase that we made after the sale, recall that we purchased 10, we have only 7 left of those. So if we go into this sales line here, we should be able to see which of these purchase lines it has consumed from. So the candidates are really all the ones that says purchase here, but we'll be able to see exactly which ones it has consumed from. just before we actually go in here and look at the applied entries, I'll just explain what I would expect it to show us. I would expect it to show us that it has consumed one from this one, and that it has consumed one from this one, because we had already consumed this one, so that was not available anymore. And then I would expect, because we sold 5, so it takes 1 from this, 1 from this, and then it needs to take 3 from this one. So let's go and have a look at the applied entries. So what it says is that it takes one quantity from 13, which is this one, and it takes another quantity, 1, from item ledger entry 14, which is this one, and then it takes 3 from number 16, which is this one. So that was quite as expected. So we can also see here, yes, the total cost amount, and the total cost amount is 18 plus 13 plus 3 times 15. So that should summarize to 76 here. We can also see now, if by the way, if we go into some of the other of the purchase lines here, we'll be able to see that if we click applied entries, we should see that it points to the one that consumed it, which is this one. So let's just do that. Yes, it was consumed by this sale down here. And if we go back to the main window here, the purchase that I've done, I'm not going to explain the GL entries of that one, because it's the same as the previous purchases. But let's just look at the GL entries of this one, of the sales invoice. So let's go navigate here and click this one. So we expected what did we actually expect? Let's just exit this window and discuss what we expect as a cost of goods sold. Well, we would expect it to consume 1 from this, 1 from this, and 3 from this. And we would expect the total cost to be 76, the total cost of goods sold to be 76. So let's just look at that. It's almost 76, but not quite. And the reason is, as before, that this one combined with this one actually gives the 76 that we are looking for. But at the point of time of selling, the average cost was 75.2, or the cost of those that we sold were a total of 75.42. And this is why it does it like that. But the main conclusion, or the important thing here, is that it has actually it has put our cost of goods sold to exactly 76 as we wanted it to, and it has consumed the same 76 from our inventory. So that is the overall implication of this, and that is exactly what we wanted it to.